Good morning, everyone, and welcome to the conference call for Pandora's Q2 results. I am John Beckman from the Investor Relations team. I'm here with our CEO, Alexander Lacik, our CFO, Anders Boyer, and the rest of the IR team, Christopher Malmgren and Mikkel Johansen. There will be a Q&A session at the end of the call. As usual, please limit yourself to 2 questions at a time and get back into the queue if you have additional questions. Slide 2, please. Please pay notice to the disclaimer on slide 2, and then turn to slide 3. Alexander, please go ahead.
Thank you, John, and welcome everyone who are joining us in this call today. As you will have seen from our guidance upgrade, the strong momentum continued in the second quarter. In fact, a record revenue quarter for Pandora. We are moving from strength to strength. During the pandemic, we have stayed focused on rebuilding our company and invested for the long term. We have maintained a high marketing investment, continued to bring exciting product innovation, continued to invest in our digital capabilities, as well as strengthening our organization. We have laid a very strong foundation for the new strategy called Phoenix. We will review this new program in great detail in the upcoming virtual Capital Markets Day on September 14. Let's now drill a bit deeper into the second quarter. As you will see in the presentation, we continue to discuss our performance versus 2019, as this represents a cleaner base without impact from COVID-19. In the second quarter, sell-out growth versus 19 was plus 7%. We are very pleased with this result, as yet again we confirm playing in positive comp territory. The strong performance in the US continued, with unusually high market growth that I will come back to. In our key European markets, we saw clear and sequential improvement when our stores started reopening. The strong growth lifted our Ebit Margin above 25% in the second quarter, demonstrating the operating leverage in our business model. All in all, a very strong quarter for the company given the external circumstances. Now, let's move to slide 4, please. As a consequence of the strong results and an updated full-year forecast, we upgraded our financial guidance for both organic growth and Ebit Margin in 2021 on August 6. Organic growth is now expected to be in the 16 to 18% range, driven by better underlying performance and a revised forecast. This is equal to a 3 to 5% organic growth rate versus 2019. Anders will shortly give more perspective on our assumptions and corresponding numbers. Ebit Margin is now expected to be in the range of 23 to 24%. This is driven by the higher expected growth rates turning into higher operating leverage. We are also continuing the distribution to our shareholders with a further 1 billion DKK over the next 3 months, split evenly between dividend and share buyback. Let's move to slide 6, please. Apologies for a busy chart, but it's important to dive a bit deeper into the varying country results and the drivers thereof. Generally speaking, though, the key driver of the variance continues to be how much COVID-19 restricts our ability to operate the physical store network. Using the second quarter of 19 as the comparison, this quarter we saw 7% sellout growth, despite that around 15% of our stores were temporarily closed due to COVID-19. In US, our largest market, we continued the very high growth of 63%. It's fair to say that a market that historically has grown low single digit has been unusually benefiting from the stimulus checks. In addition to this, we have strong indications that Pandora has been building market share on top of this situation. We do expect that there will be a natural correction once the fiscal stimulus is removed. It is, however, unclear how this demand curve will be shaped. We continue to invest for strong growth in the US to ensure we have momentum over and above those market dynamics. In China, we saw sequential improvement in the quarter. However, growth was still negative versus 19. Please note that in Q3, China has been impacted both by typhoons, which caused flooding in parts of the country, and new outbreaks of the Delta variant. This will be visible in the third quarter performance. In the second half of 21, we will take the first significant steps in the transformation to reposition our brand. Timing obviously depends on the recent C19 development. It doesn't make much sense to invest heavily in media and marketing if there's little traffic in the stores. More on the opportunity in China to come at the Capital Markets Day. UK, which is our second largest market, was up 1% versus 19. Since the reopening, traffic started to return to stores and online's performance continues to be strong. In our key European markets, we experienced sequential improvements when stores started to open up again, as restrictions eased. Slide 7, please. In May, we launched Pandora Brilliance in UK. It's our way into the diamond market. Brilliance is the first platform tested under the new Phoenix strategy, with the objective to become a new, sizable and important concept platform next to Moments. We're roughly 100 days into the test launch and progressing well. We're gaining important insights that are critical to sharpen a potential global launch. A decision of this will be taken later in the year. We will share more details about Brilliance at the CMD as well. Next slide, please. Let's have a look at our underlying performance. As said, we think 19 is the best comparison base. There are two major and opposing factors at play here. First, there is no doubt that COVID-19 continues to impact our performance, with the lockdown of stores dragging down revenue. Some of that is obviously recovered online. Furthermore, we can also notice a slower recovery in parts of the world where governments have been more restrictive with supporting people as well as businesses. Latin America as a region is one example. Secondly, the unusually strong US growth, accelerated by stimulus packages. It is hard to pinpoint the net impact of those two factors. However, we are confident the underlying sellout growth versus 19 is positive in the second quarter. Next slide, please. The strong brand momentum is the driving force of revenue growth and Ebit margin expansion. This is no surprise to us, as we continuously have kept our marketing investment at a very competitive level. Our continuous advancements in digital marketing, better advertising quality, more consistent and holistic communication, both on and offline, pays dividends. Our global unaided awareness remains high and even increased the relative gap to competition. We maintain a leading position in 5 out of 7 key markets. In terms of our global share of search, around 1/3 of the Google searches for branded jewelry is for Pandora, well ahead of competition. Net, we continue to stay top of mind as well as engage with our consumer base. I expect that competitors will start to reactivate their efforts as we start moving towards more stable conditions. There is no doubt that the investment we've made during the pandemic will continue to cement our leading position. Next slide, please. Looking back, we are extremely pleased with the accelerated efforts to build out not only our digital marketing efforts, but likewise our e-commerce business. In most countries, our e-store is the largest portal to the brand. Our digital results in Q2 are very encouraging. Online revenue made up a quarter of the total in Q2. Our online revenue more than doubled versus 2019. Comparing to Q2 of last year, online was down as expected, as consumers returned to stores. We continue to focus on driving full price sales across all our trading channels. Less promotional activity drove down our online discounts by 6 percentage points compared to the Q2 of last year. Finally, we're expanding our omni-channel features where and when it makes sense due to C19. There's a very strong consumer interest in, for instance, click and collect in the US. That made up 13% of our online sales in the quarter. Digital plays a key role in our new strategy, both as a foundation for the strategy and as a growth driver. But more on this to come on the upcoming CMD. Next slide, please. I want to give an update on the situation of our staff and production in Thailand, since the COVID-19 outbreaks there have escalated during the last couple of months and government restrictions have increased. First of all, the health and safety of our employees comes first, always. To protect our employees and to mitigate the risk of disruptions in the supply chain, we have taken a broad range of precautionary measures. This includes regular proactive testing of all employees. If a case is detected, there is immediate quarantine of close contacts and separation. sealing and cleaning of the area where a case is detected. Normally this procedure is conducted within 24 hours and then we're back up again. We are in very close dialogue and cooperation with Thai authorities, and we are closely monitoring our suppliers as well. We took a decision earlier this year to hire an additional 1,000 people into the production. One of the key reasons was that we wanted to increase our inventory position as an insurance policy against increased C-19 impacts in Thailand. It's safe to say that this was a good decision, as we're now in a position where the guidance under current circumstances is safeguarded. Next slide, please. We look forward to unfolding the Phoenix strategy at our online CMD on September 14. The executive leadership team will then present how Pandora will drive long-term, sustainable and profitable growth, building on the vast untapped opportunities within our existing business. We will be disclosing our financial targets at this time. We will make material available in advance on our website so you can digest it before the presentations begin. The CMD will be accessed via our website, where you can also find additional information ahead of the event. I will now hand over to Anders to go through the financials in more detail.
Thank you, Alexander, and please go to slide 14. We are quite pleased with the financial performance in the second quarter, and that's not just on the top line and EBIT, but also on KPIs such as the gross margin, cash conversion, and leverage. And as you can see here to the left on this slide, our leverage was only 0.4 times by the end of the second quarter, and thereby actually below our capital structure policy range. And this obviously leaves some room for future cash distribution to our shareholders. And I can't help pointing out the significant uplift in earnings per share, which you can see in the last row in the table. And the fact that we have no more restructuring cost and at the same time grow the top lines gives a pretty significant uplift in EPS. And we have not shown ROIC or return on invested capital on the slide here, but the improvement would also have been very visible in ROIC if we had put it on the slide up here. ROIC ended at 44% in the second quarter and significantly up versus the last few years. So let's go to the next slide where I can explain a little bit more about the revenue development in the second quarter, slide 15. And let me start out by saying that we do know that the revenue development is not easy to understand, especially versus 2020. The impact of COVID-19 here in the second quarter is significant and can be difficult to understand. We have provided quite some detail for the same reason in the bridges here and in the company announcement, and we hope that you find it useful. All right, but in the middle of all of this COVID-19 noise, the most important KPI is the number that we put in the green box, the plus 7% sellout growth versus 2019. That's a number that confirms that the company is growing, and it's growing versus a clean base in 19 where we didn't have any pandemic impact. And as you can also see in the bridge in the upper part of the slide versus 19, there's a 7% bucket called normalization of sell-in and other. And that bucket includes a few things such as the commercial reset we did back in 19 as part of Program Now, with the purpose of reducing wholesale inventory, and many of you probably recall that. But it also includes good performance in other points of sale, as well as higher online freight income. And both of these last two items is not included in sell-out growth, but only included in organic growth, the way that we calculate it. And I would like to stress that inventories in the wholesale channel are at healthy levels, and that we don't see any issues with old inventories or excess inventories going out of the quarter. So that was the easy bridge, so to speak. But in the bridge below, where we compare to the second quarter of 2020, is a little bit more complicated. And most of the building blocks in the bridge are hopefully quite straightforward, or you recall them back from our first quarter announcement. But there is another slightly more technical, tricky building block, which is also a consequence of the pandemic, and that's the 7% bucket that we call shift from online to other points of sale, the plus 7% there. And that bucket includes the effect of that the lower COVID-19 impact this year leads to a shift of revenue from online last year, which is included in sellout, to other points of sale this year, which is not included in sellout. And normally when you have these shifts, that's not really an issue, but when you have shocks to the system, so to speak, like in the second quarter last year, this become visible in the way that the KPIs are calculated. A little bit technical, but this should be the only quarter where we have this effect of the pandemic. So if you go to the next slide, please, slide 16. Our second quarter Ebit margin was 25.2, and actually the highest second quarter level that we have delivered in 3 years. Contrary to the revenue bridge, I'm not going to spend much time on this slide, and we'll actually go directly on to slide 18 and the upgraded guidance, and put a few more words on that. On slide 18 and then subsequently on slide 19, we are bridging back from 2020 through the old guidance and into the new guidance. And this is mostly background information for modeling purposes, and there shouldn't be any big surprises here, but there are a few things that we just want to call out. And the first thing is about the pandemic assumptions behind the guidance for the rest of the year. And we assume that around 5% of the stores will be temporarily closed in the second half of the year. And that number is obviously associated with high uncertainty, but on the other hand, we need to make an assumption behind the guidance. And on August 6th, when we upgraded the guidance, around 6% of the stores were closed. Today it's around 8% of the stores that are closed, small stores that are closed in, among others, China and Australia compared to August 6th. Another C19 assumption is that we expect no major disruptions, or assume no major disruptions in the supply chain in the back half of the year. You should also expect that China will remain a drag on group performance in the second half, and that the third quarter will be impacted by the recent increases in COVID-19 cases, as Alexander mentioned, as well as the flooding in July and the typhoons that we've also seen in China. And then we have been encouraged to specifically write what the guidance leads to in terms of real money, not just percentages, but kroner. So we've added that here, as you can see in the last column, and the guidance that we have given is translating into a revenue of between 22 and 22.4 billion kroner for the full year. So if you go to the next slide, please, and the Ebit margin. As Alexander already mentioned, the higher Ebit margin guidance is driven by operating leverage, and I think the bridge here is quite self-explanatory. But so I'll just mention two other smaller changes to the guidance, which are mentioned on the slide here as well to the right, and that includes a slightly lower capex and a few more store closures than what we guided previously. And these additional store closures should just be seen as normal ongoing optimization of the network. But we want to make clear that this does not indicate any change in our overall network strategy. We still see ample white space around the world and ample opportunity to expand the network, and we'll talk more about that at the Capital Market Day. Then a few more slides on the guidance, and slide 20 and 21, we have looked at what our full year guidance implies for the second half of 21. And first on this slide, we look at the implied revenue growth. And the data that we're showing on this slide is versus 19. And the guidance of that we have made of versus 2020 of 16 to 18% organic growth corresponds to 3 to 5 when you look at it versus 19. And that's the number you can see in the last black box in the upper part of the slide, plus 3 to 5% organic growth. And the implied organic growth for the second half is therefore between +2 and +5, and that's the box in the middle in the upper part of the graph. And then we break down that 2 to 5% implied second half growth in the lower part of the graph. And the way that we are thinking about the guidance is that it corresponds to an underlying sellout growth of between +2 and +6 in the second half of the year. And that's the first black box to the left at the bottom of the slide. And that number confirms that we do believe that Pandora is back on a growth track. Compared to the 19 base, which is obviously clean of COVID-19 impact, that +2 to +6% sellout will be offset by the continued temporary store closures driven by the pandemic, and that's the -2 to -3 that you can see in the pink box. And then when you convert it from sellout to organic growth, you should think about adding around 2 points to growth, to the sellout growth, and this includes, among others, that we were running the commercial reset back in 19, which reduced sell-in to wholesale partners back then. We have received quite a number of questions about whether the guidance is conservative, and just a few comments on that question. As Alexander already said, we have already obviously put out the guidance there because we think it's a proper reflection of how 21 could play out. There is a lot of uncertainty coming from the pandemic, and that's not just the direct effect from lockdowns, but it's also secondary effects such as shifts in how consumers are spending their money. But it should also be clear that if the US continues at the really high growth rate that we saw in the second quarter, or just something close to that, then that would be an upside to the guidance that we have put out. But let's see how that plays out. Next slide, please. For the EBIT, the guidance implies a 23 to 25% margin in the second half of the year. And there's 2 cuts on that margin guidance, or implied margin guidance, that we would like to make. And first, comparing with this, the second half margin last year, and then looking at the margin development on a sequential basis versus the first half of the year. If we start out looking at the roughly 3 percentage points lower margin versus the second half of last year, then the big drivers of that 3 points lower margin in our implied guidance. That's first of all that we are starting this year in the second half the investments related to the repositioning of the brand in China, and that will be a 150 basis points, 1.5 percentage points drag on the margin in the second half of the year. Additionally, there's a 2 percentage points drag from the higher silver prices in the second half compared to last year, and that silver price impact is partly offset by a favorable foreign exchange impact. So the net silver and foreign exchange impact in the second half of the year is around half a percentage point drag versus last year. So that's 1.5 points from China, half a point from FX and silver, so and combined a 2 point drag on the margin. And then the rest is sort of smaller bits and pieces, but importantly including less or no government support. And you might remember from the numbers last year that we got 110 million kroner in government support last year, or roughly 1 point of government support looking back towards last year. Then if you turn to look at the margin from a sequential point of view, then the margin pickup in the second half, which Pandora is usually seeing, is a bit lower in 21 than in prior years. And the reason for that are twofold. First of all, it's due to that the strong US growth that we have seen in the first half of this year came at very limited incremental cost and lifted the margin in the first half of the year. And secondly, as I just mentioned, it's the investment that we're doing in the repositioning of the brand in China that will be a drag on the margin here in Q3 and Q4 of this year. So another way to say it is that there's no underlying structural changes to the business model in the margins baked into this guidance. Enough about the guidance. Last slide from me on slide 22. And as Alexander already mentioned up front, we are continuing the cash distribution. During the last 3 months, we have paid out 1 billion kroner, evenly split between dividend and buybacks. And we still have ample liquidity, a very low leverage, and over the next 3 months, we will distribute another 1 billion kroner, also evenly split between dividend and buybacks. And assuming that the pandemic doesn't worsen, Pandora expects to continue a cash distribution also in the fourth quarter. And with that, I'll hand it back to Alexander and slide 24.
Thank you, Anders. So, to summarize, our revenue was record strong for the quarter. Sellout growth and EBIT, as Anders has just gone through in detail, was very strong, so we are extremely pleased with the performance given the circumstances. We upgraded our financial guidance ahead of the results and will continue distributions to our shareholders. Phoenix, our new strategy, is in progress, and there's more to come at the online CMD on September 14. And with those remarks, we're ready for the Q&A. Operator, please go ahead.
Thank you. If you'd like to ask a question, please dial 01 on your telephone keypads now. Once your name is announced, you can ask your question. If you find it's answered before it's your turn to speak, you can dial 02 to cancel. Our first question comes from the line of Fredrik Ivarsson of ABG. Please go ahead. Your line is open.
Thank you very much. First question on the US sellout growth up, I guess, 60% during the first 6 months versus 2019 levels. And I appreciate that it's a very difficult forecast to make, but it would be kind of helpful to understand your base case assumptions for the US market over the second half of the year.
Thank you for that. And maybe I can start out there. I think we'll not go into details on expectations on the guidance per market, but obviously I think it would be strange not to assume that there will be a slowdown in the second half of 2020 compared to the very high level that we've seen in the first half of the year. But I think the way to think about the guidance for the second half of the year is that it's likely that the US will still be above the average of the group. China will remain a drag, and then we'll see improved performance in the European markets.
Okay, that's helpful. Thanks, Anders. And the second one on the sequential improvements in key European markets that you mentioned. Did that trend continue in Q3, or have you seen something else due to the Delta variant, for instance?
Yeah, we will expect as the markets are opening up that we will see continued improvement in Europe. As you can see on some of all of the data that we have released this morning, in the key European markets, we were at -6% sellout versus 19 in the second quarter, with a third of the stores being closed. And I think if when we look at that number, it feels kind of good in the stomach to assume that, well, hadn't we had a third of the stores being closed, those key European markets would probably have been in a plus.
Thank you.
Thank you. Our next question comes from the line of Lars Topholm of Carnegie. Please go ahead. Your line is open.
Yes. Hi, guys. A couple of questions from me. One is on the reduced summer sale, which you mentioned. So, two questions in relation to that. I wonder if you can put some words on exactly how much it means in terms of absolute revenue reduction. And maybe can you comment if that particularly hit June, and what does that suggest about your growth in June? And second, just in relation to your margin bridge, Anders. So in Q2 here, more full price sales dragged up the gross margin, and I couldn't see any impact from that in your margin bridge for the full year. Is that because you expect that second half year will have as much discounting as last year, or is it simply so small so you didn't factor it in? And then a second question, because now Alexander, you commented on current trading in China, pointing out that floodings and typhoons, etc., had hurt revenue. I just wonder if you can put some words on current trading in the US, since it's so important for, well, the overall business, but of course also for growth for the rest of the year. Thanks.
So on the summer sale, maybe we can come back with a specific detail. I can just provide some context, because the end of season sale happens in different weeks across different markets. So some fall in June, some fall in July. But if just going back to 2019, our end of season, that kind of 4-week period, which cuts across the 2 months, represented roughly 1/3 of the sales. Now it only represented 15%. So there's a dramatic reduction of the end of season sale, which obviously comes at the back of a much smarter management of our assortment, much better merch policies. So therefore we simply have less, let's say, bad performing product to put on the summer sale. But maybe John and team can come back to you with a more specific answer on the absolutes, how it cuts across the months.
But Alexander, maybe to make it easier, can you say something about what growth was in June? We know sell-out for the quarter was up 7% versus 19, but according to this, I assume June was significantly lower, maybe even down. Is that correct?
You can assume that June was pretty much in line with the quarter.
Okay, thanks.
Hand over the other questions to you, Anders.
Yeah, thanks, Lars, for the question about that. On a year-over-year basis, the lower discounts and summer sale is supportive on the gross margin, and we have a little bit of wording of that in the company announcement where we talk about the gross margin. The reason we haven't put it into the Ebit margin bridge is that it was already in the original guidance that we assumed that there would be lower or more full price sell through this year. So when we compare it to the guidance, but on a year-over-year basis, it will be supportive of the margin. But at least when we compare to 2020, there's so many pluses and minuses, and last year we also had this extraordinary cost of the close down of the production in Q2 of last year, that it kind of drowned in all of the other impact. But the way to think about it is that it will be supportive of the gross margin on a year-over-year basis, that we are seeing a less discount. We expect to continue having less promotions in the second half of the year compared to 2020 and compared to 2019 for that matter. That's in the plan.
And Anders, can you just remind me what are the other mitigating factors in terms of gross margins in a situation where commodities are a drag?
Are you thinking about specifically for the quarter, Lars?
No, I just think going forward. I mean, now FX is a mitigating factor. more full price sales as a mitigating factors, but as far as I remember, there are a couple of others.
Yeah. If we think ahead for the gross margin on a let me just think about that when we look at it going forward. Hang on a second. Then we will have the silver price, which will be a drag going forward on the gross margin. It will be less so than what we than if you just a few months back, the silver prices have dropped a bit, but it will still be a drag going forward. So one way to think about it is that just from memory, the first half gross margin is just below 76.8. I can just see here. If we use that as a starting point, then on a run rate basis, we will have the silver prices will be $4.5 higher than that. We had 19 in as the silver prices hitting the P&L in the first half of the year, and right now silver prices are 23.5, 23.7, I think, something like that this morning. So that would be a 150 basis points run rate drag on the gross margin going forward. So, and then foreign exchange, there will be a bit marginal support on the gross margin going forward. The Thai baht is lower than what we have seen in recent times, and that would be some 50 basis points support to the gross margin. So these two sort of external factors, commodities and FX, net, that's a 100 basis point drag on the gross margin compared to the first half. And then the offsetting factors, long answer before getting to what you actually asked about. There will be continued cost savings on COGS. We still see some opportunities on that as revenue grows, where there will be some leverage from the higher production volumes. So simply spreading out the cost of the setup in Thailand across more units. And then there will be a bit of continued channel mix support. So net, long answer, you should expect that there will be the gross margin would be slightly down to flat on a run rate basis. That's the way I would think about it.
When the current commodity prices have full impact, that's correctly understood, right?
Exactly. Yes. Yeah.
Fantastic. Thank you very much, guys, for answering my questions.
Our next question comes from the line of Magnus Jensen of SEB. Please go ahead. Your line is open.
Thank you for taking my questions. First on Brilliance, Pandora Brilliance, maybe you could tell us how much of marketing has actually been behind the launch in UK, and also on Brilliance, if you decide to launch outside of the UK, is it fair to assume that US will be the first market you will go into and then globally following you? And then secondly, on the stronger performance in other points of sale, you mentioned, I think it's a year ago or so now, that you mentioned you would start doing a bit of a different approach to other point of sales and roll out into other types of point of sales. You haven't talked too much about that since. Is this something that is a result of that? I see that you are back with Christ in Germany, for instance. So it would be great to have some flavor on how you're doing, on why you're doing so well on other point of sales. Thank you.
So I think we will not necessarily disclose our marketing figures for this initial period. We can delve in a little bit more into detail in the CMD. I hope you can appreciate that. And then your second question on the other point of sale. I mean, of course, given COVID, there's been some restrictions on how much you can do when networks are opening and closing and potential partners are in or out of this. But we have made some moves. So in Germany, we have started to work with Christ, as you very well mentioned. But again, Germany has been closed to large portions of since this corporation started up. Then we made some moves with El Corte Inglés